The rounding bottom, often called a saucer pattern, is one of the slowest and most gradual reversal formations traders study, and its patience-testing nature is exactly what makes it different from sharper patterns like double bottoms or head and shoulders. Instead of clearly defined peaks and troughs, price drifts downward in a smooth curve, flattens out near the bottom over an extended period, then gradually curves back upward. The overall shape resembles the letter U, or the profile of a saucer, which is where the name comes from. This pattern can unfold over weeks or even months, making it more common on longer-term charts than on short intraday timeframes. Volume tends to trace a matching U-shape. It's typically elevated during the initial decline, as sellers push price down, contracts significantly near the bottom of the curve as selling pressure exhausts itself, and then gradually expands again as the curve turns upward and buying interest returns. This volume pattern helps distinguish a genuine rounding bottom from a stock that's simply drifting sideways or continuing to slowly decline. Confirmation comes when price breaks above the resistance level established near where the original decline began, ideally accompanied by a noticeable pickup in volume. Because the curve is so gradual, there often isn't a single dramatic breakout candle the way there can be with sharper patterns. The move above resistance can be a slower grind rather than a sharp spike. For traders studying this pattern, the framework typically involves waiting for that resistance break rather than trying to guess the exact bottom of the curve while it's still forming. Attempting to call the bottom early, before the curve has clearly turned and resistance has broken, is one of the most common mistakes, since a slowly declining stock can look like the early stages of a saucer for a long time before either continuing to fall or genuinely reversing. Risk management typically involves a stop loss placed below the lowest point of the curve, since a break back below that level would undermine the bullish thesis entirely. Because the formation is so extended, position sizing and patience matter more here than with faster patterns, and traders often treat this as a longer-term setup rather than a quick trade. The main limitation of this pattern is time. Its slow development means it's easy to misjudge, and a stock that appears to be rounding can simply resume its downtrend without ever completing the pattern or breaking resistance. Context, sector trends, and overall market conditions all matter when evaluating whether a rounding shape is likely to resolve bullishly. This video is for educational purposes only. It does not constitute financial advice, and trading involves substantial risk of loss. Always do your own research and consider your own risk tolerance before making any trading decisions.